My position on this is that a 60/40 portfolio is good, but incomplete.
Mm.
It's just capital formation markets, it's stocks and bonds. It's completely ignoring all the risk transfer markets, all the futures and the forwards and energies, metals, grains, all the soft commodities unnecessarily. And I would point out that a 60/40 portfolio historically has not been bulletproof. I mean, most people have been paying attention during a disinflationary period. So from 1982 to 2020, the 60/40 portfolio had every advantage. Started off with high rates. You had disinflation and declining rates and expanding multiples. Literally everything that could go right did go right for a stock and bond portfolio during that period of time. And bonds were negatively correlated with stocks. So you got a free perfect hedge in there too. So something that compounded at 7-8% a year and was a great hedge against what was on the other side of your portfolio, compounding at 9 to 11 or 12% a year. So what I'm saying is that that's as good as I could model it out. If I went back in time and did a Monte Carlo simulation of all the future possible permutations, that would be in the 90th percentile. That's what you got, right? So, but if we look at other periods of time, say from 1940 to 1980, bonds had a total return that was negative in real terms. They lost money for 40 years. 40 years. And there was nobody in 1982 saying, you're a moron if you don't own bonds. Nobody. And at the end of the 70s, no one wanted to own equities. So I just view the 60/40 portfolio as kind of a lumbering attempt at diversification that has a rearview mirror looking back 20, 30 years that is rosy. That's the top decile performance of what you should expect from that portfolio. And I feel like you give up nothing by bringing in other asset classes that add a tremendous amount of value, because an all-weather portfolio is going to have stocks, it's going to have bonds, and then it's going to have these positions in all the risk transfer markets, and can hold up a lot better in a period like the 1970s, which is really from 68 to 82. It was 14 years of pain for people that were passive stock and bond investors. So I just look at it and say they're taking risk that's uncompensated. So I agree with BlackRock that a 60/40 portfolio is not a great bet, simply because the comparisons are tough and a Goldilocks period and people's expectations are way too high. But I can't tell you what 60/40 is going to do going forward. I just feel like it's incomplete and it's not the greatest bet on the planet.
I love Morgan Housel's idea. I'm going to misquote it somewhat, but it's effectively like your lifetime accounts for 0.001% of history, but it accounts for 99.9% of how you think about history. And so if you look at the average financial advisor is a 60-year-old man, right? So a 60-year-old advisor who's lived through a period of incredible performance for bonds, right? And a 60/40 has been a wonderful thing to do for a long, long time. But I think we have to become students of history, and we have to become market historians and know that what got us here may not get us there, and to think more expansively about what the future might look like if conditions change. And it seems like in some ways they have.